welcome to our weekly High Rock video. If you are watching, on my screen here, if you are watching for the first time and are interested in learning more about High Rock, please check out our website at highrockcapital.ca. I'm Scott Tomlinson, and with me is my partner and colleague and the founder of High Rock, Paul Tepsich. Today we're going to talk about our three asset models and any updates on developments in and around our tactical strategies and what we see happening in the global economy, in financial markets, and other issues pertinent to the world of wealth management. Well, Paul, we always talk about bonds leading other markets, and what we're seeing, certainly in the United States and also in Canada, is that yield curves continue to flatten, which, as most of our listeners know, if that continues, historically, that leads to a flat yield curve, and a flat yield curve has in the past led to recessions. So what are we thinking? We saw some inflation data last week out of the US. It wasn't anything too out of the ordinary or out of the unexpected. So what do you think?
Well, I think two things. I mean, obviously the curve continues to flatten. Everyone should know why by now, because the Fed and the Bank of Canada, the Federal Reserve in the U.S. and the Bank of Canada and here have been raising short-term rates, i.e. overnight, and that really prompts a flattening of the curve. But one thing we probably should mention and haven't shown is that government bond yields are going up. So this is what's called a bear market flattener, which means lately, especially today, in fact, all bond yields are going up. It's just that over time, as we can see on this graph, the front end, or the 2-year bond yield, is rising at a higher or quicker rate, quicker pace than the 30-year. And today being an exception, in fact, where 30 years are up about 5 basis points and 2 years are only up about 2 basis points. But it's still, they raise rates, and the prospect of two things happens. Inflation becomes more tame because there's a slowing in the economy, and then a recession usually follows. So those two things are like death and taxes.
And the next increase in short-term interest rates from the U.S. Federal Reserve is expected to happen in next month.
Yes.
So stock markets, last week we saw, or actually it was Friday, but we saw U.S. equity markets, the S&P 500, break out of its recent downward trend, that buying pushing through that selling resistance. But interestingly, we look at trading volume, and you can see those along the bottom. Trading volume relative to what it was in February, where we saw huge volumes. Now we're seeing considerably lighter volumes as U.S. equities move a little higher. And
yeah, that's a good point, eh?
I'm sorry?
Sorry, it's a good point. When it's sold off, it was on strong volume, which is never a good sign. And when it's rallying or going up, it's on weaker or lower volume, which again is not a great sign. And it's tough, Scott, to figure out if this is like a breakout or not. It looks like it's above that sort of April 2nd or 3rd peak. And it seems like it's above the trend line, but this is more of a art than a science if we're looking at charts.
Yeah, well, just to give people sort of a general idea of how we're thinking, we still think that U.S. equities generally, while they are getting a little bit less expensive as earnings start to come through, and as earnings expectations continue to be somewhat higher, for at least for this year. There is some relative value where there is buying support, but at these levels now, it's dubious, really, whether buying U.S. equities is really a value play in any sort of way. We look at the global equity index. It's broken out a little bit more from its selling resistance trend, again, after touching on the buying support a few times. So again, global equities seem to have some positive upside momentum, but we look at the trading volumes once again, and they are significantly lower than they were with all the selling back in February. So again, we're not seeing what we would classify as really key signs that equities are representing any real strong value at this particular point in time. Although we have bought a little bit on dips at the support levels since February, right?
Yeah, we did do a little bit of buying at the support levels. Well, quite a bit over time when it's dipped down. And we had some newer clients that just joined us, and we did do a bit of buying a few days ago before this market popped up, as you can see, the last 3 days. So, and we just really wanted to get them more invested to where the rest of our clients were on a few line items, a few securities.
Yeah, yeah. But as far as any sort of major, we've not made any major shift in our general thinking that at these levels, it's still pretty expensive to be buying U.S. equities. Global equities, probably pretty much the same. Now, a bit of a different story when we look at what's been going on in the Canadian equity market, right?
That's for sure. We're almost back up to where we were in January. Yeah, it's been an enormous move in Canada, and largely led by the energy space. With Canadian energy, both heavy oil and light sweet crude, the differential to US WTI moved quite dramatically for a host of reasons I won't get into. But one thing I guess we could just say is, companies and energy companies, not to a large degree, but most companies carry leverage. So they have operating leverage to, in this case, the commodity that they explore for and produce. So if a company has leverage of 3 times versus its debt to cash flow, if you will, and the commodity moves, 5%, that stock is probably going up, 15%, or a whole bunch more, because a lot gets built into it. So that's exactly, I think, what's happened in Canada over the past, 2-3 weeks here.
And a lot of this is oil prices being higher, generated to a large degree by Middle Eastern issues. Certainly the Iran nuclear deal and the U.S. backing out, as well as perhaps some of the instability, I would say, that is being created over there. Correct?
Well, yeah, that's U.S. oil. Specific to Canada, we've had a few reasons as to why various classes of Canadian oil have done remarkably better, especially in light of the political situation that we're probably all aware of with transportation or infrastructure issues out in British Columbia. So, there are a few reasons why, but anyway, that's a big move in Canada. We have lightened up a little bit. I've got another sell target in, and one of the oil stocks we own. It produces roughly half of its revenues in Canada and half down Permian basis in Texas. So it's somewhat hedged between Canadian oil and U.S. oil, but we want to see if this can run a little bit more.
Excellent. And one of the things that I talked about last week in my blog, and something we've mentioned in the past that we keep an eye on, is the level of debt that people have used to borrow, that investors have used to borrow or borrow to buy equities. And this compares in gold, that margin debt level against what's been going on in the S&P 500. And we've certainly seen some adjustments in ownership of stocks, but margin debt remains close to its record highs. So it's something that concerns us a little bit that we'll keep an eye on. Historically, again, back in 2000 and again in 2008, as margin debt tumbled with stocks tumbling, which has a bit of a snowball effect because as the stock prices come down, the lenders ask for more cash against the ownership of those securities, and that forces selling of assets, and in this case, obviously expensive assets that are stocks. So something that we're keeping an eye on, but it certainly is, again, part of this debt levels, the debt levels that have crept higher on a global scale that are lying underneath the surface, and that if economic issues do arise, that could be a bit of a problem. And as we are pretty late in the cycle, we're keeping a close eye on that. Paul, any comment?
Not in that chart, nope.
Okay. Well, that being the case, that'll be it for this week. Thanks for taking the time to tune in. We certainly appreciate your feedback. I want you all to feel free to send us questions. Next week is a long holiday weekend, so we're going to be back in 2 weeks from today. But until then, we hope you have a great rest of the week and a wonderful long weekend if you're in Canada.